If I had to walk into this market today from scratch, knowing what I know about the AI spending race, the chip shortage psychology, the cloud build-out, and the way money is suddenly chasing anything tied to compute, I would not treat this like a normal green day. Most people look at a stock going up and think, okay, nice, maybe I made a little money. But that is not what this is anymore. This is the market trying to decide who owns the infrastructure of the next economy. Today is Saturday, April 25th in New York, and I want you to comment the day and date you're watching from, because I want to see where everyone is seeing this move from. And if you value these breakdowns, support the channel by subscribing and commenting John AG Best, because that tells me you want more calm thinking when the market starts screaming. So let's get started. Nvidia is the headline, obviously. When a company already sitting around $5 trillion starts moving like it still has something to prove, you have to respect that. You do not have to worship it. You do not have to chase it blindly, but you do have to respect what the market is saying. And the market is not just saying Nvidia is strong. It is saying the entire AI supply chain is being repriced. That is the part that matters. Because if Nvidia alone moves, maybe it is one company. Maybe it is one headline. Maybe it is enthusiasm around one chip cycle. But when Intel suddenly wakes up, when AMD starts ripping, when ARM, Qualcomm, server names, memory names, and semiconductor indexes all turn bright green together, that is a different message. That is no longer one stock flexing. That is capital saying, hold on, maybe the compute boom is not slowing down. Maybe it is broadening. And that is exactly why days like this are both exciting and dangerous. Exciting because big trends can create life-changing wealth. Dangerous because the easiest time to lose discipline is when everything you own looks brilliant. I know it feels amazing. You look at the screen, everything is green, and suddenly your brain starts writing retirement speeches. But markets are very good at making you feel smart right before they test whether you actually have a plan. So here is the framework. This is not just about chips. It is about intelligence becoming infrastructure. That sounds dramatic, but think about it. AI is not only a chatbot. It is not only a cute productivity tool. If businesses actually start using agents, coding systems, customer service automation, research assistance, ad generation, logistics planning, healthcare workflows, fraud detection, and internal decision systems, then every answer those systems give requires compute somewhere. Training is the big visible build. Inference is the repeating bill. And repeating bills are where the market starts paying attention. Based on recent market updates, the largest cloud and technology companies are still committing enormous amounts of capital to AI infrastructure. That does not guarantee every dollar will earn a beautiful return, but it tells you the people closest to demand are not acting like this cycle is finished. They are acting like capacity is still the problem. That is why AMD matters. AMD is not Nvidia. Let's not pretend otherwise. Nvidia is the scoreboard, the symbol, the king of this trade. But the kingdom is bigger than one company. AI needs accelerators, it needs CPUs, it needs memory, it needs networking, it needs packaging, it needs power, it needs foundries, it needs racks, cooling, buildings, transformers, and time. So when AMD gets upgraded and starts moving hard, the question is not, is AMD the next Nvidia? That is too simple. The better question is, can AMD become one of the pressure valves in a market desperate for more compute? If the answer is yes, then the stock does not need to become Nvidia to matter. It just needs to capture a meaningful piece of a market that keeps expanding. Same with Intel, but with a different flavor. Intel has been the stock people loved to ignore. Then suddenly, because of stronger guidance, government support, strategic investment chatter, and renewed demand for CPUs tied to AI workloads, it starts acting like the old giant still has a pulse. Now, I would be careful here. A big Intel move does not magically erase years of execution problems. One rally does not fix manufacturing credibility. One good forecast does not make every old wound disappear, but it does show something important. The market is willing to pay for turnaround potential when the industry backdrop is hot enough. That is a powerful cocktail, and sometimes a dangerous one. Because once investors start believing the whole sector is going higher, they stop asking which companies deserve it. That is how real themes become crowded trades. Now, Microsoft is another piece of this puzzle. I know people want the exciting names. They want the explosive chart. They want the company that jumps in a straight line and makes everybody on social media act like they saw it coming. But Microsoft is more subtle. It is sitting inside the enterprise workflow. It has Azure. It has Copilot. It has the OpenAI relationship. It has distribution that most software companies would crawl across glass to get. And yet the market still debates whether the AI spending is creating enough return quickly enough. That is the key. Microsoft does not just need to spend. It needs to show that customers are adopting, renewing, and expanding AI tools in a way that turns into durable revenue. From the latest publicly available cloud updates, capacity constraints, and AI demand are both still part of the Microsoft story. That is good because demand exists. It is also challenging because capacity costs money before it becomes profit. That is the AI paradox. The more demand you have, the more you must spend to serve it. Amazon has the same issue, just wearing a different jacket. People look at Amazon and see deliveries, fuel costs, warehouses, and consumer spending. Fair. That is still real. But the market is watching AWS because AWS is the AI engine room. If AWS demand is strong, investors can forgive a lot. If AWS disappoints, suddenly every cost line looks uglier. And Amazon has one advantage people still underestimate: physical scale, warehouses, logistics, cloud regions, chips, customers, developer relationships, all of it matters. In an AI world, the company that already owns infrastructure does not start from zero. Google is in a different position. It has the models, the cloud, the distribution, the search cache machine, and now the Anthropic relationship keeps getting more attention. A planned investment of up to roughly $40 billion tells you this is not a casual partnership. It tells you the biggest companies are not just chasing upside. They are protecting themselves from irrelevance. That is the hidden force behind AI capex. Fear. The fear that if you underbuild, your competitor gets smarter faster. The fear that if you wait for clean proof, the next platform shift has already happened. The fear that the cost of being late is larger than the cost of overspending. And that is why I do not think this AI trade is only greed. There is greed, obviously. There is always greed. But underneath it, there is corporate fear. And corporate fear can fund build-outs for a very long time. Now let's talk about the bubble argument. Because the bears are not crazy. I know bullish people hate hearing that, but it is true. If a semiconductor index runs for weeks, if valuations stretch, if every dip gets bought, if people start treating trillion-dollar companies like penny stocks, then yes, risk is rising. That does not mean the trend is fake. It means the price you pay matters. The internet was real in the late 90s, but plenty of internet stocks were still disasters. Railroads changed America, but investors still got wrecked in bad railroad securities. Electricity changed the world, but not every electric company became a forever winner. So the question is not whether AI is real. The question is whether your holdings have earnings power, customer demand, balance sheet strength, and a valuation that can survive disappointment. That is where portfolio discipline comes in. If Nvidia has become too large in your portfolio, that is not a moral failure. That is what happens when a winner wins. But you need a rule. Maybe you trim when a position becomes emotionally dangerous. Maybe you diversify inside the same theme. Maybe you use covered calls if you understand the trade-off. Maybe you hold because your tax situation makes selling expensive. But do not make the decision because a candle scared you. And do not make it because a green day made you feel invincible. That is how people turn great trades into emotional casino tickets. SoFi is a great example of a totally different setup. It is not a chip stock. It is not going to move just because AMD is having a monster day. SoFi has its own battlefield. Credit quality, loan sales, default concerns, rate expectations, and whether investors trust the accounting and the balance sheet. Recently, a short seller dispute put more pressure on the name, and SoFi pushed back hard. That does not mean the bears are automatically right or wrong. It means earnings and disclosures matter more now, because the market wants clarity. And here is the twist. Rate cuts can help lenders, but if rate cuts come because white-collar jobs are weakening under AI pressure, then that is not a clean positive. If borrowers lose income, defaults matter. If defaults rise, the market will not care that the 10-year yield looks friendlier. That is why AI is a double-edged sword for financial names. It can improve efficiency, it can lower costs, it can also pressure the exact customers who borrow money. Crypto is another separate pocket. Bitcoin and Ethereum have not been acting like the leaders of this equity rally. They still have a long-term argument, especially if AI agents eventually need payment rails, stablecoins, or tokenized settlement. But right now, crypto has that winterish feeling where believers still believe, but price action is not exactly throwing a parade. And the recent Iran-linked wallet sanctions are a reminder that digital assets are not outside the system. They can be tracked, frozen, pressured, and pulled into geopolitics just like everything else. That does not kill crypto, but it does kill the fantasy that it floats in some magical separate universe. Now, one more thing. The Microsoft and Meta workforce stories matter. When large tech companies are offering buyouts or preparing layoffs while spending aggressively on AI, that is not random. That is the labor market starting to absorb the message. Companies are saying, we need more compute and maybe fewer people in certain roles. That is great for margins if it works. It is uncomfortable for society if it moves too fast. And it is complicated for investors because the same technology that lifts productivity can also create political pressure, consumer stress, and credit risk. So yes, I am bullish on the AI infrastructure story, but I am not blind. I think the winners can still go higher, especially if earnings confirm demand. I think Nvidia above 5 trillion is a symbol, not necessarily an ending. I think AMD can matter. I think Microsoft may be more important than the chart currently admits. I think Amazon and Google are fighting for cloud relevance in a way that makes their next few reports extremely important. But I also think investors need humility. If everyone becomes convinced there is no top, that is usually when the market reminds people gravity still exists. And remember, this is also why the market can look expensive for longer than bears expect. When the buyer is not a hobby trader but a hyperscaler with a strategic panic problem, valuation math changes, not disappears, changes. A cloud company does not buy chips because the chart looks cute. It buys chips because customers are waiting, competitors are racing, and every month of delay can become a permanent strategic disadvantage. But the opposite is also true. If these companies overbuild, if power becomes too expensive, if model improvements slow, or if customers decide the tools are useful but not worth premium pricing, then today's winners can still face painful resets. That is why I keep coming back to evidence. Orders matter, backlogs matter, utilization matters, gross margin matters, free cash flow matters, not vibes, not memes, not somebody yelling that a stock can only go up, and the power story might become the next major chapter. You can announce a model in minutes. You cannot build a grid connection in minutes. You cannot permit a data center in minutes. You cannot magically create advanced packaging capacity because traders got excited before lunch. This is where the real world pushes back against the digital dream. So if you are looking for the next layer, do not only stare at the most obvious ticker. Watch memory, watch networking, watch cooling, watch power equipment, watch cloud utilization. Watch whether enterprises renew AI tools after the first excitement wears off. The first wave is always the promise. The second wave is the invoice. The third wave is whether the customer says, yes, I want more. That is where fortunes are made or lost. And when that pattern shows up across multiple earnings seasons, then you are no longer watching a trade. You are watching a capital cycle. So the plan is simple. Own quality, understand your thesis, watch earnings, watch CapEx, watch margins, watch whether AI revenue is moving from promise to habit. Do not buy random names just because they say AI. Do not sell great businesses just because they finally worked. And do not let one unbelievable market day convince you that risk has retired. If you're successful, share your success story in the comments so others can stay motivated. Because the real goal is not to win one day. The real goal is to build a process that survives the next exciting rally, the next scary correction, the next analyst upgrade, the next earnings miss, and the next headline that makes everybody panic. The market is telling us AI infrastructure matters. The market is telling us semiconductors are no longer just cyclical hardware names. The market is telling us cloud capacity, memory, CPUs, GPUs, power, and data centers may define the next phase. Now we have to see if the earnings prove it. That is the whole game, not hype, proof. And until the proof breaks, this AI build-out remains one of the biggest stories in the market. This is for education and perspective only, not financial advice. Do your own research, know your own risk, and never let my excitement or anyone else's excitement replace your own judgment.